Here with analysis, we have our very own Liz MacDonald, economist Douglas Holtz-Eakin, Danny Blanchflower, professor of economics at Dartmouth College, Brian Wesbury, chief economist at First Trust, and Steve Cortes, BGC macro strategist. Quite a team. I'm going to start here with you, Steve. As we've been saying all along, this seems to be a Fed that wants to have its cake and eat it too. In other words, they've promised over and over again that they want to move on rates, but they just don't seem to have the wherewithal, or at least the economic growth, to justify it. Your reaction to this news?
Right. You know, Trish, my reaction is that Teddy Roosevelt used to say about American foreign policy, speak softly but carry a big stick. Well, Janet Yellen is the anti-Teddy Roosevelt. They speak very, very loudly, and they carry no stick at all. And listen, they are in a predicament. I think that recent jobs report really put Janet and the rest of the FOMC in a corner. The last time they tried to hike rates, global markets went into a cataclysm in January. So they certainly have to be very, very careful. But I do not expect any increases this year. I don't.
You mentioned something which is pretty important here, and the Fed's credibility really seems to be on the line. You've been talking to a lot of folks on Wall Street today, Liz, about their expectations for this. And I think people are feeling a little bit burnt out by this Fed, because it's like they tell us one thing and they promise they're going to do something, and yet it doesn't really happen.
Yeah, to Steve's point, they don't just talk loudly, they talk a lot. And you're right. And so now what we're thinking, based on what Peter Barnes is saying, Wall Street is now thinking, is you're going to see 0.75%, to that range of 1% by the end of the year if they stick to the 2 rate hikes. And Jeff Gundlach, who runs the $100 billion double line fund, he's basically saying that the Federal Reserve has lost credibility and they've lost control. Now, this is a guy who correctly called the slowdown, dramatic plunge in oil, that gold would go up and that Treasury yields would go down and China would slow down. He's saying that the Fed has lost control. Look at that the negative 0 rate policy, this low rate policy around the world, is not working to basically ignite growth.
Let's go to Brian Wesbury. Brian, has the Fed lost control?
Yeah, I guess my answer would be pretty simply yes. And here's the reason. You know, first of all, I do not believe the December rate hike caused the market to fall in January and February. I think that was a market correction. It was emotional. It really had nothing to do with the Fed. And this is the reason. Every time in history the Federal Reserve has ever raised interest rates, the way they do it is they withdraw reserves from the system. In other words, if you want the price of corn to go up, you burn 100,000 acres of corn, right? And so up until today, every time the Fed has raised rates, they do it by taking reserves out. Today, there are $2.25 trillion in excess bank reserves in the system. If they would have raised rates today, they would have not reduced reserves by 1 penny. So this idea that a rate hike is tightening monetary policy, it's just not true.
Danny,
all it is saying
right?
rates are higher.
Are we in a completely different world than the previous one in which we all lived, and this is sort of uncharted territory for the Fed?
Absolutely. We've never been at the 0 lower bound before. We've never been in a situation where 16 European countries are in deflation. Other countries around the world are doing quantitative easing, and they have negative rates. So anybody who thinks a previous tightening cycle tells us absolutely anything, I'm afraid, is totally mistaken. We are in a new world where actually everything is propped up by the monetary stimulus. So if you think of the commentary, supposing that's true, then many of the comments about, oh, this thing hasn't worked, are completely wrong. This whole growth we've seen is propped up by the monetary stimulus.
Okay, let me just clarify for everyone what Danny's saying here. He's saying, thank goodness for the Fed that the little growth that we have right now is all a result of them and their policy. You like what they've done, Danny?
Well, they had very little alternative, and in some sense the argument is about the counterfactual. Bernanke's counterfactual was that unemployment would have gone to 25%. That's about the right counterfactual to think. So anybody who says, oh, this thing hasn't worked, is simply saying there was really no shock.
I mean, Douglas Holtz-Eakin, I would just, I mean, when you look at 0.8% growth, you got to wonder, and 38,000 jobs being added in the last month, is the Fed actually able to achieve any growth? I mean, isn't this at some point you're pushing on a string, Douglas?
Look, I think there are two different things. Was the Fed super effective at stopping the fall? Absolutely. Since then, it hasn't got the tools to make growth go faster. And what we've seen again and again is exactly what we saw today. The Fed comes out and says, we're going to do continued accommodation or greater accommodation. Oh, and by the way, we were wrong about the growth forecast. We've got to mark it down. So this isn't working. And we've got unemployment below 5%, and we've got core inflation at 2%, and we should be closer to normal monetary policy.